agreement, or PPA. By tokenizing the
where massive algorithmic trades happen away from the XTX markets, are actively hedging against this.
The fundamental thesis here is incredibly fractionalizing power purchase.
Not at all. That
Rational response to sheer operational innovation.
Who is buying every single stock? Who is really behind the dark pool activity? Watch until the end and you will find out more.
102.84%. That is the explosive single-day gain we witnessed on March 2, 2026 for Turbo Energy SA, trading under the ticker URB. The stock closed at exactly $1.37, but the price is really only half the story here. The volume is what truly demands our attention. We saw 110.288 million shares change hands in a single session. To really put that into perspective, that volume is 546.7 times their 20-day daily average. In a single day, it instantly added roughly $9 million in valuation to what was, just 24 hours prior, a sub-$10 million market cap company.
Right. And it's precisely that unnatural volume explosion that forces us to, pause, step back, and ask the truly uncomfortable questions about what is actually happening beneath the surface.
Exactly. The central question we are unpacking today is this. Does this unprecedented market activity reflect a genuine fundamental turning point driven by Turbo Energy's massive new industrial backlog? Or, and this is the crux of it, is it a precarious, retail-driven microcap bubble masked by complex market maker mechanics and, frankly, severe underlying financial risks? I argue that the data points to a legitimate structural turnaround heavily validated by institutional debt restructuring and their highly scalable artificial intelligence energy management system.
And I contend that the underlying reality here is a high-risk liquidity trap completely overshadowed by a looming NASDAQ delisting, extreme dark pool hedging, and a highly concentrated insider control structure.
Okay, let's break down the operational trajectory first, because the fundamental catalysts here are just incredibly hard to ignore. On that pivotal March 2 date, Turbo Energy didn't just announce a vague partnership. They announced $53 million industrial backlog of signed contracts. We're talking about 366 megawatt hours of deployed and scheduled capacity.
Yeah.
And that is spread across 10 active, large-scale manufacturing facilities for their Sunbox Industry Max system. For a company whose entire market cap was, hovering in the single digits just weeks prior, securing a $53 million backlog provides years of concrete revenue visibility. To me, it definitively proves that the commercial and industrial market has a massive appetite for AI-driven peak shaving to mitigate volatile energy spot markets.
But let me just add one more thing. We aren't just taking the company's word for it. On February 9th, 2026, they secured a massive debt restructuring of 4.87 million euros, which is about $5.75 million, with major conservative Spanish banks. We are talking Bankinter, CaixaBank, and BBVA. That is a definitive institutional vote of confidence that completely secures their financial runway for expansion into the US and Latin America. I come at it from a completely different way. You look at that backlog and see a miraculous turnaround. I look at the structural market reality and I see a mirage. Takes a breath. The massive buying volume you referenced on March 2, it was almost entirely retail-driven. If you look closely at the Q4 2025 and Q1 2026 institutional filings, the actual smart money didn't just trim their positions, they completely abandoned ship.
Well, legacy institutions.
Let me finish this thought. Citadel Advisors, Morgan Stanley, and UBS Group AG all fully exited their positions by early 2026. We have to ask why. Did they leave because they suddenly hate AI energy tech? No, they saw the precarious financial foundation and walked away. We simply cannot ignore the January 12 NASDAQ deficiency notice. That notice explicitly cited that the company had only $1.5 million in equity against the $2.5 million minimum requirement to stay listed.
Look, I hear you on the deficiency notice, but...
And hanging over this entire retail frenzy is a $100 million shelf registration. For our listeners who might not be deep in the weeds of SEC filings, A shelf registration basically means the company has the legal right to suddenly create and sell a massive amount of new shares whenever they choose, up to that $100 million limit. It is a giant dilution threat just sitting on the shelf, waiting to be executed on current shareholders so the company can raise cash and regain compliance. So the real takeaway here isn't just that the stock popped, it's a classic microcap tug of war. Incredible technological promise on paper, wrestling with a potentially toxic balance sheet in reality.
I see why you think that, but let me give you a different perspective on how we interpret these market mechanics versus fundamental demand. The exit of legacy institutions like Morgan Stanley doesn't negate the demand for the equity. It simply changes the profile of the buyer. Legacy banks often have strict mandates against holding sub-dollar microcaps facing delisting notices. Their exit is procedural. It's not necessarily a judgment on the technology. You are right that the ownership is concentrated.
Highly concentrated. I mean, it's practically a closed loop.
Yes, Umbrella Global Energy owns 75.48% of the outstanding shares. But the broader market interest we saw in early March is a rational response to sheer operational innovation. Look at what they are actually doing to solve the adoption bottleneck in the energy-as-a-service market, which is a $145.18 billion industry. In November 2025, they launched a tokenization pilot with Taurus SA and the Stellar Development Foundation.
Which sounds great on a press release, but let's unpack what that actually means for the bottom line.
What it means is revolutionary for their sales cycle. They are fractionalizing power purchase agreement debt on the blockchain. Let me explain that simply. Imagine a massive commercial factory wanting to install a solar microgrid. The upfront capital cost is astronomical. Traditionally, a single bank has to take on all that debt via a power purchase agreement, or PPA. By tokenizing that PPA on the Stellar blockchain, Turbo Energy is essentially breaking that massive debt into tiny digital pieces. Anyone can buy a fraction of that yield. This brilliantly solves the high upfront capital cost barrier that usually stops commercial solar adoption dead in its tracks. The massive volume we are seeing reflects the market finally waking up and pricing in this technological leverage.
I'm sorry, but I just don't buy that. Let me tell you why. The volume is completely deceptive precisely because of that artificially low float you just acknowledged. Let's trace the ownership. Umbrella Global Energy owns 3/4 of the stock, but Umbrella Global Energy is 54% owned by Crocodile Investment. And who owns Crocodile Investment? It is 100% controlled by Turbo Energy's chairman, Enrique Selva Belvis.
Right.
The actual public float, the shares available for regular people to trade, is microscopic. So when we see market-making firms like Virtue Financial doubling their position to 22,136 shares in February, that is absolutely not a value investment in blockchain tokenization.
You don't think Virtue recognizes the value of the underlying asset?
Not at all. That is simply a market maker accumulating inventory to facilitate a retail frenzy. The off-exchange data proves this beyond a shadow of a doubt. On February 17, the FINRA short volume ratio hit 39.70%. On February 23, it was 30.51%.
Those are standard hedging metrics during a volatility spike.
Nearly 40% of the off-exchange volume was short selling. For anyone unfamiliar, off-exchange trading or dark pools are essentially wholesale back rooms where massive algorithmic trades happen away from the public eye so they don't crash the public price. This data tells us that algorithmic liquidity providers like XTX Markets are actively hedging against the spike in these dark pools. They are shorting the stock to manage their own risk while they provide shares to retail buyers. They are managing a mathematically dangerous, low-float environment. They are not buying into a fundamental turnaround thesis.
That's an interesting point, though I would frame it differently. High short volume ratios and dark pools for microcaps experiencing a news-driven breakout are entirely standard market maker hedging mechanics. It is the plumbing of the stock market. It is not necessarily a fundamental indictment of the company's business model. Virtue and XTX providing liquidity does not somehow invalidate a $53 million industrial backlog. The contracts are signed, the factories are waiting for the hardware. But let's shift away from the trading algorithms and look at corporate governance and the financial runway, because ultimately, this is where the execution of that backlog actually matters. Even the best algorithms don't matter if the company can't execute.
It matters immensely, which is exactly why the recent executive shuffling is frankly terrifying. Takes a breath. We have to look at the timeline of who is steering the ship. On February 13, Chief Financial Officer Lucia Tamaret suddenly resigns. Now, she had only been in the position since October 2025, barely 4 months. What makes this deeply concerning is the timing. She stepped down exactly 2 weeks before the critical February 26 deadline to submit their financial compliance plan to NASDAQ.
Executive turnover happens, especially during stressful restructuring periods.
But look at who steps in. The 52-year-old CEO, Mariana Soria, takes over as interim CFO. Slow, deliberate emphasis. It is like trying to fly a commercial airliner while simultaneously climbing out onto the wing to fix the engine with a wrench. We have a CEO acting as his own CFO during a massive international expansion, while simultaneously navigating an existential financial crisis, a bank restructuring, and a NASDAQ delisting threat. That is a massive red flag for corporate governance. You need a dedicated financial expert handling a crisis of that magnitude, not a CEO stretching himself across both roles.
I'm not convinced by that line of reasoning because it ignores the actual operational output during Soria's tenure. I hear you on the timing, but I think you're looking at the wrong metric entirely. Executive transitions, while poorly timed and admittedly messy, are often just a growing pain of a rapidly pivoting company. You are looking at the empty CFO's desk, but I am looking at the balance sheet and the actual product viability. In 2024, sales of their Sunbox Home segment grew by 130.7% year over year, hitting $1.92 million. Furthermore, their Sunbox Industry System, which is the exact product driving this massive new backlog, contributed an immediate $1.65 million in its very first year on the market.
Past revenue on home systems doesn't solve a current balance sheet crisis.
But it proves the demand for the core asset. And the core asset here isn't just solar panels. It's their Artificial Intelligence Energy Management System, or AIEMS. Let's clearly define what this AI system actually does, because peak shaving isn't just a glorified battery timer. It actively predicts local weather patterns to estimate solar yield. It monitors the factory's historical consumption down to the minute, and it analyzes grid spot prices in real time. It uses all that data to autonomously decide whether to use stored energy to power the factory or sell that energy back to the grid when prices spike. That software is a highly lucrative hard asset. That is exactly why incredibly conservative Spanish banks agreed to a $5.75 million debt restructuring. They looked at the proprietary technology, looked at the industrial contracts, and saw a highly valuable risk-mitigating asset that justified extending the runway.
That's a compelling argument, but have you considered the regulatory catalyst rapidly approaching on March 18? Because all the claims about the AI technology's intrinsic value and all the defense of the executive team's pure intentions are about to meet a very harsh, very public reality check.
You are referring to the upcoming SEC rule change regarding the Holding Foreign Insiders Accountable Act.
Exactly. And this is a massive shift in the microcap landscape. Effective March 18, 2026, foreign private issuers like TURB Energy finally lose their long-standing exemption from Section 16A reporting. Up until now, foreign executives had a massive loophole. They didn't have to report their stock trades in real time like U.S. executives do. But under this new rule, for the very first time, executive officers and directors of foreign companies will be legally forced to file Forms 3, 4, and 5 to report their holdings and their transactions to the SEC.
Which simply puts them on an even playing field with domestic companies.
It puts tracking devices on their wallets. Up until now, the retail investors driving this massive volume spike have been flying completely blind regarding insider activity. This new transparency will finally expose the truth. We will see, in plain daylight, whether interim CFO Mariano Soria and Chairman Enrique Selva Belvez are quietly using this massive surge in retail liquidity to exit their personal positions, or if they are actually holding strong. Given that $100 million shelf registration hovering over the market like a dark cloud, I strongly suspect this forced transparency might trigger a stark reevaluation of management's true confidence. If the forms drop and we see insiders dumping shares into the retail rally, the whole turnaround narrative collapses.
Actually, I welcome that transparency. The dark pool ambiguity and the off-exchange shorting metrics you cited earlier thrive in an information vacuum. Speculation runs wild when people can't see the data. Once those Form 3s and 4s hit the SEC database, it will instantly clear away the speculation. If insiders are holding, which I strongly anticipate they are, given the sheer logistical scale of their 366 megawatt-hour deployment schedule, the market will finally be able to refocus on the company's ability to execute. The March 18 deadline isn't a trap. It's a clearing event. It allows the fundamentals, the signed industrial contracts, the deep banking support, and the AI software integration to stand on their own merits without the constant shadow of market microstructure paranoia.
Takes a breath. The paranoia, as you call it, is simply responsible risk management. Let's ground this in reality. A $53 million signed contract is purely theoretical paper until it translates into physically installed hardware and collected revenue. If they miss the NASDAQ compliance window and get relegated to the over-the-counter markets, the penny stock realm, the resulting institutional liquidity drain could completely cripple their ability to finance the manufacturing of those 10 facilities. You can't tokenize a PPA if you don't have the capital to build the solar array in the first place.
Slow, measured tone. As we bring our perspectives together, I maintain that despite the inherent and often chaotic volatility of the microcap space, the fundamental thesis here is incredibly compelling. We are looking at a company that has managed to secure a massive $53 million contracted industrial backlog against all odds. They have built a predictive AI solar technology that genuinely solves a painful financial barrier in the commercial energy market. And most importantly, they have secured the explicit bank financing required to bridge their transition. The massive price action we saw in March 2 is simply the market finally recognizing a major structural transformation.
Deliberate caution, and I maintain the technological promise cannot and frankly must not be divorced from structural financial reality. You cannot ignore a severe equity deficiency notice from the NASDAQ. You cannot ignore the mathematical reality of massive off-exchange shorting by algorithmic liquidity providers who are pricing in failure. And you certainly cannot ignore the looming existential threat of massive dilution via a $100 million shelf registration. The explosive volume we witnessed is a symptom of extreme market mechanics and low float constraints, not necessarily an indicator of long-term value creation.
Yet, I think we both agree that the next 45 to 180 days are absolutely critical for the survival of the enterprise.
Undoubtedly. Their survival hinges entirely on two very narrow pathways: NASDAQ's formal acceptance of their financial compliance plan and their physical ability to manufacture and deploy that signed industrial capacity without drowning their current shareholders in dilution to pay for it.
It perfectly illustrates the intense, fascinating complexity of analyzing microcap equities. You have cutting-edge technological innovation like blockchain tokenization and AI-driven energy management, colliding directly with ruthless market microstructure and strict regulatory deadlines.
The data is all there on the table, but the interpretation completely changes depending on whether you are analyzing the dark pool order book or the physical product suite.
We highly suggest that listeners pay close attention to those upcoming March 18 SEC insider filings. Those transparency documents will be the ultimate litmus test for management's true confidence in the company's trajectory. Examine the filings, track the NASDAQ compliance updates, and weigh the evidence for yourselves.
If you like this content and want to watch more videos like this, then don't forget to subscribe. Thanks for watching. See ya!